Hello everyone, welcome back. I got a lot of really good ones for you today. Markets. 3 major US stock indices haven't really done a whole lot since we last convened. Little bit of that low liquidity, low volume, summer doldrums kind of price action. Did see a little bit of a bump in precious metals, but nothing crazy. A little bit of bump in energy. We did see natural gas move up about 7% today. Hey, that's traders anticipating Russia might cut off Europe's natural gas over the winter. So these rumors start to fly. People in Europe becoming increasingly concerned over Russia cutting off the natural gas. That sends natural gas prices higher as the world starts to, as the European world starts to size up less energy, more inflation, problems with their trading partners, problems getting cheap, available energy. And so we're even seeing coal catch a bid. So on the one hand, the elites want to divest from the dirty fuels, the oil, the coal, the really dirty, expendable stuff. And they want to get towards more renewables, green, diversify the energy portfolio. But hard to do that when you're going to war with your neighbors, right? So traders are kind of seeing the reality of the situation, not looking as, I guess, green and clean. Europe might need to scale back some of their renewable endeavors and just settle for some dirty energy while Russia, dukes it out with whoever. So a little bit of action in the energy space, a little bit of growing anxiety in Europe over where they're going to get their natural gas over the winter. But other than that, markets aren't really doing a whole lot. Bitcoin just clinging on to 20. It's broken below a couple times, but it's like a game of tug of war, right? So I really do think, though, the bears and the downside for Bitcoin is getting rather exhausted. I would not want to be shorting or betting against Bitcoin. You can avoid it. It's not for everybody, but I definitely wouldn't be betting against it. And if anything, I'm rooting for the team in this tug of war that's going to keep Bitcoin above 20 and maybe make that a floor. But it's a tough range and a hell of a game of tug of war going on at around 20 for Bitcoin. So keep an eye on that. Whichever way Bitcoin breaks to the up or downside, I would expect all the altcoins to follow. Inflation data came in today, the CPI, pretty hot. BlackRock had been warning us it was going to be really hot in the weeks leading up to this. The market wasn't surprised by the CPI print, even though it came in hotter than expected. But the market wasn't really that surprised because the market's already baked in a lot of this inflation. So where you might have thought that a horrible inflation number would have sent markets tumbling today because it was much worse than expected, I really think the market's already kind of baked in some pretty horrible scenarios with regard to inflation. So when you get the numbers you were anticipating, it doesn't create as much downside as you thought. If anything, now the market's trying to look forward to the Fed at the end of the month and say, what are they going to do with interest rates? Which brings me to my next point. So markets have been pricing in these prior weeks, and myself included, a 75 basis point increase to the Fed funds rate on July 27th, so the end of this month. However, I would say those expectations now are going to go up to 100 basis points. So a full 1% move higher on the federal funds rate for the end of the month. Look for that. Look for the Fed to raise 1 full percentage. But we've talked about in prior videos, the Fed will be more hawkish over the summer, front load some of these rate hikes. They've already telegraphed this to the market, and then take some of these rate hikes off the table. They haven't said that, but I think they're going to get around to it. So I'm anticipating a 1% hike to the federal funds rate end of this month. I'm anticipating, though, that the market actually wants to see that, wants to see a concerted effort by the Fed to get inflation under control. And then if we do see a little bit of deflation, which, there's rumblings in the economy about supply gluts, layoffs, a slowdown in the economy, a recession, then the Fed will, in my view, take rate hikes off the table starting in like August or September. They'll look forward and the Fed might say, I know the market's already baked in like 12 rate hikes because we said, hey, we're going to be hiking very aggressively between now and 2023, 2024. But that was then. Look at the situation now. And when push comes to shove, it's just my opinion, the Fed will protect the beast system. So what I mean by that is they're going to protect risk assets. They're going to protect things like the stock markets, the real estate markets. They don't protect precious metals, but precious metals takes the ride along. But they'll protect, I even think they're going to protect crypto, just because crypto is becoming a productive space for finance, a constructive one. You know, JP Morgan isn't just interested in digital gold, but they are interested in being able to process like 2 million transactions a millisecond, or whatever Avalanche or Solana is going to cook up. So the B system will protect the risk assets at the expense of the dollar and inflation when push comes to shove. Just my thoughts. A lot of people, though, will take the opposite view, and they'll say, no, Mike, the Fed ain't messing around with inflation this time. They're gonna hike interest rates at the end of the month, 1%. And then they're going to keep hiking, you know, aggressively. And those bond yields are going to go up. Those interest rates are going to go up. Those mortgage rates are going to go up to 9%. And it's just going to start collapsing the economy. And the Fed's just going to kill the economy. Some people believe that. Not in that camp. If you want to be, though, hey, that's totally cool. But I believe even when growth is low and inflation is out of freaking control, the Fed will not raise the interest rate above the inflation rate and break the back of inflation, because they don't want to crash their B system. They don't want to crash the 401ks. They don't want to crash the broader indices. They don't want to crash the real estate market. So they're walking that tightrope. And I think if they start falling one way or the other, they're going to try to throw their weight over to favor the B system. And what will that look like? Trashing the dollar, more inflation in groceries, more inflation at the pump, more inflation for education, more inflation for healthcare, more inflation, more shortages, just a slower economy. And it will slow the economy down. But, you know, the Fed can always turn on a dime, print more, and protect their beast. So, you know, I know people are saying, hey, the Fed's not joking around this time. They're going to get inflation under control. The trend of interest rates moving lower for 5,000 years has finally been somewhat, perhaps structurally, meaningfully broken. Look for a new world. Look for a brave new world, Mike. Save some cash, Mike. Get interested in annuities, fixed income, CDs, like bonds. I don't see it, though. I don't see it. I say, at the end of the day, risk assets will still be protected. Ignore the volatility. And even if the economy continues to slow down, people get laid off, inventory gluts appear, prices start falling meaningfully, all that means is at a certain point, the Fed will turn around. They can do it overnight and just go ahead and reinflate everything. So I'm a bit of an inflationista, even during these recession times, which I'm here to tell you we're in a recession. And you know, the mainstream, here's something I got for you for the big R word. The mainstream's really about to just admit it because they have no choice. 2 consecutive quarters of negative GDP growth equals a recession by textbook. We're waiting on to confirm the second quarter has been negative growth, but I think the market has already baked it in and expected it anyway. So you could see a situation, because markets are so forward-looking, that the day CNBC says, oh, it's official, we're in a recession, that's the bottom. You'd be like, well, okay, they told me yesterday we're in a recession. How come the stock market just went up another 5%? Because the market's forward-looking. By the time you know for certain you're in a recession, most of the damage is already done. That's what makes markets so tricky to begin with. So just because I see the inflation warnings, just because I see the Fed getting out of control with regard to dealing with inflation, and the Fed ultimately being picked, hey, I'm going to save the stock market and let inflation get worse, or I'm going to let inflation go down, and I'm going to fix inflation and destroy my markets. You know, whichever way they go, at the end of the day, I flip back to them being an inflationista, them having to inflate, them wanting to inflate by any and all means necessary. I mean, you've noticed in the last 5 trading days that 10-year yield came down like 60 basis points. I don't think that's individual investors or even like private institutions buying bonds driving yields down. I think that's the Fed kind of managing the markets, managing expectations, keeping those yields suppressed to kind of keep a floor under the markets while they jawbone about fixing inflation in the dollar. So it's crazy. I get it. It could even be a little deflationary and recessionary. I get it. And low growth. I get it. But that doesn't necessarily mean now I'm a deflationist with regard to risk assets. So hey, I still love the NASDAQ, I still love gold, I still love Bitcoin, I still love oil. I'm still very bearish on the dollar. I think the dollar gets much weaker, both in real and absolute terms. What I mean by that, both measured, both in relative and absolute terms. So what I mean by that is I say the dollar will stay strong against all these other fiat issued government currencies around the world. Like the dollar will remain the king of the Forex, I at least in the foreseeable future, although that trend is starting to be tested and broken a little bit. But I say the dollar stays on top, but in its real and absolute terms keeps falling. So although the dollar will stay higher than the euro, the peso, the yen, the yuan, whatever, the ruble, although the dollar will stay higher than those, I'm betting that every time you go to the grocery store, you pay more. Every time you go to the gas station, you pay more. Every time you go to renew your internet bill, you're going to pay more. Your insurance, you're going to pay more. So expect to continue to see that. The only way I think that would stop is if the Fed raises their benchmark rate, the Fed funds rate, above the inflation rate. And we could call right now inflation conservatively 14% a year. So the Fed would have to go all the way to 15% on their benchmark rate, putting mortgages at like 17, 18% just to get this inflation to stop. They're dragging their feet. They don't want to do it because every time they raise interest rates, even a full percent, the markets get really weird and want to deflate. So the Fed can't raise interest rates high enough to break the back of inflation, okay? I wouldn't bet on them doing that. And not only would I not bet on the Fed raising interest rates above the inflation rate, I wouldn't even bet on the Fed raising interest rates as high as they say they're going to by 2023, 2024, which is like a 4.25% federal funds rate. That would put mortgages in the danger zone and really cull a lot of these asset classes. So I say the Fed doesn't even stick to their dot plots and projections for interest rates they're telling you going forward in the next few months. I say that the Fed's going to flip. They're going to flip dove. They're going to stop being hawkish. They're going to accept broad, sustained, entrenched inflation, whether they admit it publicly or not, and you're going to just start seeing risk assets go back up, potentially to all-time new highs. And that's not even necessarily a good thing, right? Prices are just prices. But I think the Fed will ultimately always protect their beast. So inflation came in hotter than expected today. I do expect the Fed to continue to front load some of these rate hikes, go aggressive at the end of the month, 1% bump to their Fed funds rate. But then, if things keep slowing down, they're going to have to take rate hikes off the table. And even if things don't slow down, I think in the back of their mind, they want to take some of these rate hikes off the table. They don't want to cull the beast system they exist to protect. That's just my thoughts, though. I could totally be wrong, and we're just gonna have to see. Thanks for listening. Like, subscribe. You guys are awesome. We're really building something cool. Leave a comment. Ask a question. Maybe I'll get around, see if I can answer it. But hey, I'm sure a lot of you are even smarter than me too. So we're all learning here. That's really all I got for right now. And if I don't think I'm missing anything, and if anything pops up, hey, I'll be back. So markets mainly reacting to inflation. I'm still bullish. Gold, oil, NASDAQ, Bitcoin. But I understand the dollar bull camp. If you want to be a dollar suspenders, dollar under the mattress, collect cash, save cash, hold dollars, protect your principal, hey, do you? But I want to hang out on the end of the risk curve. I'm pretty sure that's at the end of the day where Larry Fink is hanging out. Janet Yellen wants people hanging out. Jerome Powell wants people hanging out. So I think it's going to work out for those that are actually using all this fear and deflation to get long risk assets. But again, we're going to have to see. It's all up for grabs. All eyes on the Fed, interest rates. Hopefully the Fed can get inflation under control, but I don't think they're going to. And I think without admitting it publicly, they're just going to throw in the towel at the end of the day. They will always pick the beast over the dollar. Just my thoughts. Till next time.